This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. This is AJ Monty with the Market Guys, and it is exactly 8 p.m. Eastern Time, and welcome to this open house Q&A session, which is our monthly session that takes place every month on the Monday that follows options expiration Friday. Now, if you're not an option trader, that may even sound confusing. Why not just say the third Monday of every month? Well, the third Friday of every month is options expiration Friday, but the Monday that follows options expiration Friday isn't always the third Monday. So that's how I have to word that. If you know when options expiration Friday is, just remember that the Monday after that is when we have our open house. And it's really our time to get together as traders, as investors, as just the curious people that are wondering why Netflix is still going up, and talk about the markets in a way that will help us manage the risk. Now, as I usually do, I usually start off talking about the general markets and giving my overview before I take your stock symbols, but I really like to talk about Netflix first because it's in the news. They came out, their earnings, I think, quadrupled, but the most interesting thing here is even though their earnings quadrupled, look at the PE ratio. It's still at 444. So, for the life of me, I don't know what's going on in the minds of the investors who are buying this stock because everything I see about this stock is a short candidate. Institutions, and I can tell you why I think the market's going up. If you look right here, if you could see my cursor, 95% of the institutions, or actually 95% of the shares that are available to the public are owned by the institutions. So what's happening is the institutions are driving this one up. Now I'm going to tell you a little story about manipulation, and I know this for a fact because I've seen it from the inside out, and it's something you need to know about before you rush out there and start buying shares of Netflix. Again, like I said, 95% of the float, which is what the institutions and the general public get to trade, it's owned by the institutions. And as you can see, the drop-down menu there, it says the percentage of shares outstanding held by institutional investors such as pension plans. Now, the people that invest or manage these pension plans are institutional traders. Now, let me give you the story here so you can understand why it's going up. They are pushing this up on every bit of good news that they can, even though the fundamentals cannot justify these prices, and even though the technical signals are saying it's overbought. So imagine every single person on this call, imagine that they are an institutional trader. And all of us own these shares. Well, we all know that we own the shares, and we really know that we can't start selling the shares because who in our community of investors and money managers are going to buy from each other? We're not going to do that. So what we do is we try our best to upgrade the stock or push it up or get the news out. And then when the buying pressure is strong enough from the general public, what happens is the institutions will then transfer their shares to the unsuspecting general public investor, and then they are left holding the bag. And you might say, well, that sounds unethical, AJ. Well, in my opinion, it is. But according to Congress, it's absolutely legal. Let me show you why it's legal. Again, this stock, since October of 2012, so just about a year ago, was trading just over $40, almost $50. Was trading. The low actually was at 53. Now it's trading $354, almost $355. So the law states if you get on a national television program, if you're an institutional money manager, if you own the stock and you're upgrading the stock, you have to state your position. Do you own it? Do you not own it? Are you thinking about owning it? And most institutional analysts that are getting on the airwaves are saying, yes, we own the stock and we are recommending, we're putting a buy recommendation out. Now, what I can promise you this. A month from now, or even 3 months from now, between now and 3 months from now, you're going to see upgrades in the stock, in the news. Okay, you'll see right here. You'll start to see on the right-hand side. Now, this is Google Finance. So, or is it Google? Let's see. Is it Google or Yahoo? It's Google Finance. You will start to see upgrades in the stock, and what I'd like you to do is keep note of who's upgrading it. And then 3 months from now, you can go and check the institutional holdings, and you'll most likely see that the companies that have upgraded it will then be the ones selling it. I can guarantee that's what's going to happen, because again, 95% of the float is held by institutions, which means only 5% of the general of the outstanding shares are being held by the general public. And you know, I don't even like talking about this, because again, I feel that this is very unethical that they would do this. They should make this in plain language and say, tell it like it is, but they leave that up to the investors to find that out for themselves. In most cases, it's too late. You know, they've already lost money by the time they find that one out. So take this as a lesson learned, and I'm still buying puts on this one. Netflix, I still think the long-term puts are the best place to be. For those of you who are option traders, I do talk about this. If you look at the technicals now, okay, now that we've looked at the fundamentals, I want to show you the technicals, and I'm going to show you the Fibonacci retracements. Now, again, for those of you who are new to technical analysis or to the market guys, the Fibonacci retracements are based on a mathematical sequence that starts with 0 and then goes to 1. And it's a simple sequence of numbers. What you do is you take the two previous numbers. The mathematician Fibonacci came up with this long ago, found that over time, the difference between the numbers starts to level out into certain percentages that I'll show you. These are numbers that are found in nature. It's found in weather patterns. It's found in the stock market. This mathematical sequence pops up everywhere. And the way you do this is you put it on a scale. They've actually added a tool. In most trading platforms, you do have the Fibonacci retracement numbers. What you do is you take one end of your cursor, you put it on the low, you drop that to the high, and these are the most likely pullback points for the stock, with one of the most popular being the 50% level. Let me show you this. I'm going to go to price level now. 50% is right here, so that would be right around $203. Now you have to understand, if the stock pulled back to 203, you would still have an astronomically high PE ratio. But that's where I think that this stock could actually wind up. I think it could easily pull back 50% of this move, and what justifies that is what we're seeing in the volume. If you look at this, let me get my trend line here. Look at the volume bars here. Now remember, this is a monthly 10-year chart of Netflix. It's a 10-year chart, but in each candle represents 1 month, and you can see that the average high volume month after month has been dropping. Why? Now think about this. Go back to the story that I told you about the institutions. Why is the volume dropping? Because the institutions are holding the stock. They can't buy any more stock. You can't buy more than 100% of the float, so they're holding on. And they might be trading from one house to the next, but there's nothing major happening with the volume. The buyers are already in, and they're doing their best to push it up on the news, and eventually the bottom will fall out and the stock will drop. Now, the correlation between price and volume is extremely, extremely important. And what we're seeing here is a price-volume divergence. The price is going up, volume is going down. When the price is going up and the volume is going down, that's usually a sign of a weakening top. It's bearish. It's a very bearish sign. So again, before you just rush in there and start buying shares in Netflix, be very, very careful with that one. Now, for those of you that received the Oracle, which is the Trade Alert service, I did talk about Google, okay? And I was mentioning this. Here is a monthly chart of Google. Now, you can see that the Google is now over $1,000 a share. Again, another incredible thing that's going on here in the market. And if I were to put in Google, watch, I'll put Google into the finance sheet here. Let's see, GOOG. I'm going to put in Google Incorporated. And you can see, once again, now the PE isn't off the charts like it is with Netflix, but look at the institutional ownership. 71% of the float is owned by the institutions. Now, let me give you another lesson as to why there's so much institutional ownership in this one. The institutions could move a lot of money into Google with very few shares. I mean, they don't have to buy millions and millions of shares to balance the money in their portfolio. They could just buy a smaller amount, and they're not going to move the stock as much. So this becomes a very attractive stock for the institutions, very much like you have Warren Buffett with the A and B shares for Berkshire Hathaway. The institutions love that because they can move a lot of money with those as well. Google, I do think, is going to pull back as well, because I'll show you the daily chart and why that will be. You can see here that the trading channel was established. Now, I'm using this point right here as my role reversal, and this is the report. This is the chart that I put out from the alert that I put out last week. Now, this right here is a role reversal support level right here, and it just recently broke out of resistance. Now, if you understand the role reversal, you'll also know that once a stock breaks out over resistance, that resistance line then turns into support. So what I think is going to happen with Google is I think this is going to happen. I think it's going to come right back to this level, and then we'll see whether or not it bounces from that point. Notice the volume on this one as well. We had a huge spike in volume on Friday because, again, earnings drove this one up. It was record volume. And today, we see no follow-through on the buy side. In fact, we see less than half the volume today that we did on Friday, and that tells me that the sellers are already starting to move in, and most certainly the buyers have stopped buying. That volume drying up so quickly is going to really put a hurting on anyone who's bought this stock on the highs from last week. Now, let me go into the market analysis. I'll start with the diamonds. Again, this is in a trading channel. This is the ETF for the Dow Jones Industrial Average. And you can see, again, look at the volume. These are daily charts now. Look at the volume and how this is drying up. Today, it was again, less than half of the volume from last week. Less than half. And if you look at where the volume has dropped in the past, usually the volume drops at pivot points. What do I mean by a pivot point? Here's a pivot point. This was actually a selling climax, so that's a little bit different. But you'll notice that as the stock hit resistance over in these areas and started to pivot lower, look what happened to the volume, how it dried up. Again, this was back in August of this year. The volume dried up very, very quickly, and then the market started to roll over and go down. If you look, even going back here, you see the volume drying up very close to the highs over here. You see that? And the volume started, the prices started going up, the volume was going down. This is a significant low volume here because you can see that as I zoom in, you'll see that the candle pattern, these are not big green candles, and they're certainly not big red candles. These are spinning tops. And spinning tops are signs of indecision, very much like a doji. Like here's a doji back here. You get spinning tops of very small candles. Their significance is really when they follow long green or red candles. When you have big, long green candles like we did for the past week and a half, and then you have a spinning top, that is something you have to really pay very close attention to. So that's what we're looking at in the diamonds. If you look at the Russell 2000, the Russell 2000 has been in an upward trend, but if you look at the cycle, you can see that the peaks are very well spaced out. And this is a beautiful cycle where we're now hitting another peak with that red candle, and there's gaps below the market. So here we have, if we do the Russell 2000 and we do the Fibonacci retracements on the Russell 2000, take that low, measure it to today's high, 50% retracement would bring the Russell 2000 very close to 1077, which would be right at a role reversal support line that matches very closely to the 20-period moving average, which is that blue line. Okay, let's go look at the Qs. There's QQQ, the power shares for the NASDAQ. What are we seeing again? Drop in volume. You see the drop in volume at the bottom of the chart, and an increase, almost vertical move here. And what do we have? A gap below the market. Let's look at this. Fibonacci retracement. Once again, where would the 50% retracement bring us to? Right around 79.47. Where would that be? Right near a role reversal support. Remember, the resistance is back here. If I extend my line all the way across, and again, using that 50% line as my new support level, that's where I expect the Qs to pull back to. And again, look how perfectly it matches up with the 20-period moving average. So again, the Qs are telling us lower, the diamonds are telling us lower, the Russell 2000 is telling us lower. What do we have next? Let's look at the spiders. That's SPY. Now, I left my lines up here because this is what I expected the market to do. I'm a couple of days off here, but we slightly broke out of this resistance area, but look at the volume again. Boom, the volume is drying up on an upward move with the doji on the spiders, gap below the market. Let's use the Fibonacci retracements on this one. Where would the 50% line bring us to? Look at that. How perfect is that? Right to the 20-period moving average. See that? So that's where I expect the short-term market to bring us. Again, right back to the moving averages. Finally, before I go on to your stocks, let's look at the VIX. I love the VIX. I really do. In my report, I did say that I believe the VIX was going to start to pivot up. I left my line here from the support level that I, again, highlighted on that report. If I zoom in, I talked about the spinning top right here with that long shadow bouncing off of the support level. Today, we did have a higher high and a higher low on the VIX. Don't worry about the color. We have a higher low, higher high. That is the pivot point. I'm going to leave this line in place, and I will most likely report on that at the end of the week in the weekly market report. Now, if you're a member, you'll get this delivered to you. If you're not a member, then we'll post it to the Facebook page, but we're not going to continue to do that because we don't want to always and forever keep this a free weekly market report. We have to have member benefits, and we're continually building on the educational videos. We're building on the delivery of the service to your mailbox. We've offered and expanded this open house Q&A for our members. So we're always thinking of new ways to enhance the experience and build value into the service. And I tell you, Bill and I, we go back and forth, and we think that this is really the best thing out there. For $149 a month, you're getting all these services, and you're getting your stocks analyzed in an open house Q&A. So we're happy about that. We hope you are too. We're getting good reviews and good feedback from our subscribers. So again, this is the VIX. This is the path that I think the VIX is going to take. And if I do the Fibonacci retracements, I would have to do this backwards. I'm going to go from the high to the low to see where the retracement is going to be. And 50% is going to bring us right here, right around the 1683 level for the VIX. So I think that's a very, very reasonable path for that one to take. And I think that the way the VIX has been moving, you can see in the past it looks like it could spike up any day now here. So be prepared on the downside if you own any long stocks or anything that's long the S&P or the Dow. Be very, very cautious of that. Okay, now here's what I'm going to do. As I said in the beginning in the warm-up, the Q&A box actually scrolls. So again, if you've already put in a stock symbol, I'm not going to be able to grab that because it's already gone from my screen. But what I'd like to do, or actually, I'm going to ask right now, you type that in. If you did it already, type it in again. I'll try to pick that up, and then I'll grab 5 stocks at a time, and we'll go ahead and we'll analyze those. Okay, so first one, Tom, FCX. He's in at 32.40. FCX, let's take a look at that. Now, what Tom did is something that I would ask every one of you to do. If you have a position and you want me to look at the stock, then please let me know what your position is. It'll help me help you better, okay? Because if I don't know what your position is, I'm guessing at that, and I just want to help you at least identify where the stop levels are if you're already in it. Okay, Tom, FCX, it's copper and gold here, and if you look at what's going on, we have an area of role reversal resistance that we're hitting. This former support, hard to see, came down, bounced up. I'm going to measure, let me get my horizontal line in there, I'm going to measure a price level from that low point. Boom, right there. Now, that former support has been broken. When that support was created, only 3 or 4 days later, it broke down below it. And now that support from back here has turned into resistance, and lo and behold, you got 2 spinning tops at resistance. So if you own this at 32.40, I don't see any reason why you should not take a profit in this one. Now, I'm still bullish in the commodities, but if you look at the volume on this one, listen, you got to make a decision based on what you're seeing on the chart. You have 1, 2, 3, 4, 5, 6, 7. You had 7 green candles in a row before you had the red candle, and now we have another spinning top on, look at the bottom, on lower volume. It's the lower volume that should kick you in the head every single time when you're looking at this. A drop in volume tells us that the buyers are becoming less motivated. Now, there's a couple things you do. I always tell people you're in a short thing if you take at least half the shares and sell them, because if you're in at 32.40 and you sell half of them at 35, you've made 260 on at least half the position, and then you could stop the rest. Okay, so if you sell half immediately, take the profit on that. I would put the rest of my shares with the stop loss order somewhere below 33.5. How did I come up with that 33.5 level? Well, look at that blue little box. That's the 20-period moving average. If the stock breaks down below the 20-period moving average, it could go lower. It could go right down to your buy point, and now you're at break even again. So take half of the position out, take a profit in that, stop yourself out at 33.5, and now if you get stopped out, you'll at least make money on all the position, and you will not lose money. There's no reason to risk a loss on this one when you're already in the game. And there's an old saying, you should never turn a winner into a loser. So that would be my recommendation for you, Tom. Hope that helped. Okay, now Ronald wants me to look at Baidu. Ronald, did you have a position in that one? Let's see. If you have Baidu, Ronald, I have 130. You have the 130 puts in Baidu. Okay. Now, look what happened with Baidu today. It was beautiful because I wanted, in the option oracle, we recommended to buy the puts on this one. Hopefully you did that last week, and now you're making money on this one. Because if you look, it was down $4 and change, and the gap is still below the market. So I think that on the short term, this gap right here, and I'll leave that in place, I think that gap right around the 154.5 level will most likely fill. But here's what I think could happen with Baidu. you have so many gaps below the market. You have one down here. You also have one down here, that this stock could easily pull back. And look, now remember, look at my pullback points here. See this gap pullback and this gap pullback? Watch what happens when I put the Fibonacci retracements on top of the chart. Now, I hadn't done this before, but there's a good chance if I take that low, connect it to this high, you'll see that these lines are very, very close to the 61.8%. This one could go a little bit lower, but the 23.6%, I think that could pull back to that one as well. So these are very fair price targets that I put, because the Fibonacci lines are actually below here. So there's a very, very good chance that that gap is going to fill. I would hold those puts in place and look to take a profit when we get a bounce off of the key support level. Okay, now Tom says that he is VJet is new and thinking about buying. Now, okay, now Tom, are you thinking about buying the stock? I imagine so. So let me type in VJet. All right, and it's an ADR, and it does not have any price history here, so I can't really do anything with the new stock. You know, Tom, I don't like getting in any of the IPOs or any new stocks without any kind of history, because you're only going on what the reports that the company's putting out. And in any new stock, you have to understand that, of course, the company's going to be optimistic about that. But what happens afterwards is totally a gamble at this point. You don't really know. So, but what I can tell you is that if you use the 1% rule and you're thinking about buying it, I would buy the stock, and then really there's really no support level other than this gap right here. Maybe just pull that line up. The gap support is the only level of support we have right there, because in most cases when a gap fills, it'll generally reverse 80% of the time and go back up. So this is what I think the stock could do. Fill the gap and then bounce. So if you think it's going to fill the gap, I wouldn't buy it until at least it fills the gap. And then you have a support level, because once the gap fills, it'll most likely bounce from the gap. And so if you buy it at, let's say it bounces and you buy it at 29, which will be right around here, you could put your stop at 28 and then have $1 risk per share, and at least you have the 1% rule that you can use to calculate that one. So it's a high risk proposition when you have a new stock with no technicals to go on, but at least you have a gap that'll help identify support. So hopefully that'll help you there, Tom. Okay. Now Paul wants me to look at CRM, and he's looking for an entry level. He does not own it. Okay, so CRM. Now remember what I said, Paul, about the markets in general, right? That's why I like to start off with a market analysis, because, you know, if the market is looking very bearish, and it looked like all the indices that we looked at were looking bearish, why are you looking for a buy candidate? You see, got to be really careful of that. Here's another stock that has gone vertical. It's gone vertical in the past week. You have a red candle today, and you have a gap below the market. Actually, you have two gaps below the market. Hold on, let me show you. You got a gap here, right there, and you have a gap that needs to be filled here. So the best thing to do is to wait for the stock to bounce off of the 20-period moving average. Why did I didn't just pull that one out of the air. There's a reason why I picked that price. Watch. I have to go back to my price level line, and it'll show you. This role reversal, here's an area of resistance, and then it fell back. You see, the 20-period moving average acted as resistance, but then it broke through resistance, and now this line is going to act as support. So what I would do is I would put an alert to identify the price at, let's say, 52.5. Okay, Paul, so what I would say is set a price alert for 52.5. When your alert goes off, I don't know what kind of alert service you use, but there's all kinds of free alert services. Yahoo Finance has it. Microsoft Money has it. I think even Google Finance has it, where they'll send you an email. Your broker may even have it, where they send you an email when the stock hits a certain price level. 52.5 would be your number if you're looking to buy this one. Because if it does go down to this level, that would be right around 52.5. Then at 52.5, you could watch it. Then you put it on your watch list and wait for it to do this. Wait for it to bounce. And then get in and then put your stop. Where are you going to put your stop? Somewhere below support. You're not going to put it on support. You're not going to put it above support. I think it's much better to look for the pullback and the bounce before just putting in a limit buy order somewhere below the market. That's not going to do you any good. Okay, so hopefully that will help you. Okay, let's see. IBM. Let's see. Mundial is IBM at 185 long from ESPP. Okay, let's see. IBM. IBM, typing in that in right there. Ooh, IBM is down and gap down. Well, the good thing is it's gap down. That's actually a good thing. Because why? Because 80% of the time gaps fill. Let me clear my lines out because it looks like we have looked at IBM multiple times, and that's what those lines are. Okay, now let's go back. Here's IBM gapped up. Shortly after that, it came back, filled the gap, and then reversed. Here's another one. It gapped down. It went back up, filled the gap, and then reversed. Here, it gapped down, filled the gap, reversed. Here, it gapped down, filled the gap, and reversed. You see that? You see that pattern? How, again, 80% of the time, oh, my battery power. I got to check that. Uh-oh. Don't like that one. Oh, there we go. I was running low. I don't want to lose my my battery here in the web seminar. Okay, so there's a good chance that the stock could move back up and fill the gap. There's a very good chance. Now, where does that put you? Well, if you own it at 185, you're basically looking to get back to break even. Now, you're faced with a very tough position right now because IBM, now remember what we said about the Dow. We're looking for the Dow to drop. And if the Dow drops, IBM might drop further. The only good thing that you really have going for this long position is that, like I said before, it gapped down, and now the volume is dropping. Remember what I said about the volume. If the volume is dropping, that's a sign that the move is weakening. In this case, the selling activity, the sell-off, is weakening, which is bullish. But you have to decide, okay, where in the world am I going to get out if it doesn't? This is a very tough position because you already have a break in the support level here. This is a weekly chart now. Let me get to the price level. You already have a breakdown of support even here. Here's support, support, support. It's broken. So you have, on the weekly chart, you have the possibility of it going back up. But this line is going to get in your way. Even though it's close to 185 and that gap could fill, that resistance is going to get in your way. The only other support that you have is back here. It's down there, right around 157. So you have to make a decision. Am I going to hold on until it goes all the way to 157 and bounces? Or do I take my position and get out and wait? Well, again, the way to answer the question, and this is going to be critical for you. Whenever you have a losing position and you're faced with having to make that decision whether or not to get out or stay, you have to ask yourself this question. Please remember this. Now remember, we're recording this so you could memorize this. The question is, if I did not have a position in this stock, would I be buying it right now? Now I would go to the day chart to answer that. If I did not have a position in this stock, would I be buying it right now? Well, the answer would be no. But the market is closed right now, so there's nothing you can do about it. So here's what we do, and you have to really, this is a very tough position, and I hope that everyone's learning from this one. Let me zoom in. Where is my next short-term support? Now we already identified the long-term support down there around 160 something. My only lifeline here, my only short-term support is this low right there. That's it. Today's low and the low from Thursday. That's it. So you have to make a decision. You have to say, if it closes below 172 or 172 and a half, you need to get out. Gap or no gap, you need to get out because you can't risk it. And then when the stock makes a decisive move higher, then you can, of course, get back in. IBM is not going to go away anytime soon, so you have to really keep an eye on that one. Now, George is in a position. Now, George is in IBM at the bottom of the gap. Okay, now, George, the bottom of the gap here, here's the gap, or the bottom of the gap from that day. So here, on this day, did you get in on the low around 173 or so? If you could help me out with that, that'll help you. Okay, let me see. I'm waiting for George. There's a little bit of a delay there, so waiting for George to answer. Let's see. Okay, George, the answer is yes. So you got in on the low. All right. Well, you're again in good shape, but here's my question to George. George, where is your stop? What price is your stop? And if you don't have an answer for me, then you should hang up right now and go discipline yourself. Just kidding. But you really, okay. No stop. Oh, George. George, you got to get a stop. All right. George, you have to put a stop in below 172. If it closes below the support level, you got to get out. And here's the danger. Remember what I said about, look, let me go back to diamonds. Look at this. Weakening everywhere. Look at the Russell 2000. Weakening, we already looked at that. Look how far away it is from the 20-period moving average. Look at the Qs, okay? It's weakening. Look how far above it is from the moving average. Remember that rubber band theory? Let me get rid of these lines so you can see that more clearly. Here, this is why you have to be really careful. Do not be involved in this market without any stops. Sebastian, I will get to you. Thank you. I see you. I'll save you some of that frustration. You've typed in INFY enough times, so I think you deserve me to answer you. Okay, now look at the moving average, and look at the price relative to the moving average. Look at the Qs. Look at how far away the stock moves before it pulls back. This is the furthest that the Qs have moved away from the moving average in the past year. It does not like staying this far above the moving average. This is the rubber band theory. Imagine, again, remember that rubber band. Imagine a rubber band connected to the moving average, another end of the rubber band connected to the price. The rubber band's being stretched big time now. It does not like to stay that far away. There's a very high probability the Qs are going to drop. That's why you have to keep stops in, especially on your long positions. All right, so I don't want to beat you up on that one, George, but be really careful. Okay, be really, really careful on that one. All right, let me go to Sebastian. INFY is what Sebastian is asking for, INFY. And, okay. Oh, he's shorted. Beautiful. Oh, thank you. All right, finally, we got someone who's shorting the market. Now, let's use this as a perfect example, okay? Now, first of all, Sebastian has shorted this at 54.49, so only 3 cents away from where we are right now. Now, let's analyze the stock. First of all, remember the moving average. Remember what we said about that. Look how far the stock is away from that moving average. Does not like to stay that far away. It doesn't like to go that far below it either. but this is a beautiful short candidate. It's far above the moving average. It's at a resistance point. Oh, what happened there? I gotta get my price level. There we go. It's right at a resistance point. Resistance, 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 again resistance. You have a gap below the market, and look at the price going up relative to the volume. What's the volume doing? Look at that. It's dropping beautifully. This is exactly what you want to see in a short candidate. Okay, now Sebastian, I'm going to turn the tide on you. Where is your stop? I'll wait for that answer. It's going to be a little delay. Now, folks, if you are short the market, your risk is to the upside. So you're not going to put a sell stop. You're going to put a buy stop in the market. Now, Sebastian, either you're not answering me or you're embarrassed. Okay, there we go. 55.80. Okay, Sebastian, you've obviously read my book. 55 is resistance, and Sebastian has put a buy stop at 55.80 above the resistance point. That is perfect. That is perfect. And again, for those of you who are looking for short candidates and you're ready with your pad and your pencil, here we go. This is one. By the way, if you're new to the open house Q&A session that we're doing here, this is a great place to pick up ideas. And you just got one right here. If you're looking for a short candidate, INFY is a perfect short candidate. Thank you. Thanks to Sebastian bringing it up. And Sebastian, you're doing everything perfectly right there. Now, here's my second question for you, Sebastian. You've obviously gotten yourself into a good short position. You're following the rules, and you put in your stop above the market. Where's your target price? At what point would you look to take a profit and move out of the stock? Where would you do that? Again, I'm waiting. There's a little bit of a delay there. Okay, around 51. Okay, now I'm going to highlight that, and I know Sebastian already knows this answer. Here's 51, right there. Why did Sebastian pick that level? Can anyone tell me? Type in your answer. First one. Gap closed. Yes, thank you, Gil. The gap would be closed. That's what we're expecting it. What's another reason he might have put it at 51? Not just the gap. What else? Moving average. Thank you, Stephen. Absolutely right. If a stock is this far above the moving average, it will have a very strong tendency to come back to the moving average. Now, 51 is not exactly on the moving average. Why is that? Because over the next day, if the stock doesn't go dramatically lower from this point, this moving average day after day will start to creep up until the stock pulls back. So you more or less have a meeting in the middle, so to speak. But I think that 51 area is really a good target price. Now, to help Sebastian out one more time, Sebastian, right at the top of that gap is 51.5. You see that? Right, actually 51.40. If the stock gets to 50, well, actually it's showing 51.34 on my price level there. If it gets to 51.34 and bounces, if I were you, I would be prepared to close the position there, even though you have a price target of 51. Okay, so that's a great example of how to play a short position. Okay. Now let's see who else. Jan. Okay, PBT. Thinking of getting in. Imagine you think about getting in on the long side. So PBT. Let's take a look. Ooh, no. I would not even touch that one. Getting in. That's all the reasons to get out. You got the stock pulling way above the moving average. The only thing that I would say that's going to cause this one to go down, you need to see a drop in the volume first. Let's take a look at the weekly chart and see how this one looks. You got a roll reversal right there. The most I would expect on the upside for this stock is right around 16.5. So you only have roughly 50-something cents there. I wouldn't even think about that as a long position. No, that would be dangerous, very dangerous. Again, look. Now this is a weekly chart now, going back 3 years. Look at the move this stock has made away from the moving average. Now, keep in mind, folks, when I switch this from a daily chart to a weekly chart, see in the daily chart this is a 20-day moving average. When I switch it to the weekly chart, it's now a 20-week moving average. And look at how far the stock has moved above that moving average in the past before crashing back down to it. See, it's actually, if I'm not taking a ruler here or anything, but if I were to measure the distance from here to here, it looks to me like that would be the furthest point above the moving average in about 3 years. And so you really got to watch that one. On the downside, it looks like it moves further away from the moving average, but then again it likes to snap back to it. So I would actually put this as a short candidate, and I would only short it though on the next red candle on lower volume, and then I would put a buy stop above 16.5. So probably around 17 I would put a buy stop. All right. All right, let's see. Paul is looking at CRE long at about 61, and you have a $5 trailing stop. Okay, let's take a look at that. CREE. All right, you long this one at 61. It's trading 73. This is the weekly chart. Now, Paul, before I switch to the daily chart, can you see anything on here that might cause you to be concerned about your long position? Here, I'll give you a hint. Resistance, resistance, we're at resistance. Again, this is a weekly chart. It's only Monday, so that today's volume doesn't really count for the week. We still have a lot of week left. But it looks to me like the volume is dropping week after week for the past 3 weeks. The stock has moved significantly above that moving average. Now, let's look at the daily chart to zoom in on this. Okay, you have a spinning top, almost a bearish engulfing pattern here. Very, very close to a bearish engulfing pattern. If this stock had closed any low, if it had closed below yesterday's opening price of around 73.29, that's only 11 cents away from a bearish engulfing pattern. Be really careful with this one. Now, you said it looks that you have a $5 trailing stop, which means if it's trading at 73.24, 73.40, you're at 68.40. That would put your stop somewhere below the moving average. If you're okay with that, I mean, listen, you could turn this winner into a loser if you took that stop out. But at least at 61, you are still protecting your stop. You're still protecting your profit if you have a $5 stop. I think this stock could pull all the way back to fill this gap down here, right near your entry point. Now, I tell you, when you have that much of a profit and the markets are looking that bearish, I say, again, at least sell half of it. Sell half the position tomorrow, and then I would still move my stop up though. I don't know if $5 is a lot for this one. I would put my stop somewhere below this low right here. I would put my stop right below, let's say 71.30. That line right there is 71.42. I would put a stop at 71.30 and stop your other half out at that point, and be a hero if you get stopped out. You're winning on both of those halves. So that could help you there. Okay. Now, Jan is going back to her position. Jan, what was that one? That was what was that one? PBT. Jan was looking to get in after it corrects. Well, Jan, here, if that's the case, then here's what I would do. Here would be your entry point for this one. Resistance, 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 broken will turn into support. So if you're looking to get into this one, this is where I would get in. Well, wait for the stock to do this, bounce, and on that pivot point I would get in, and then I would put my stop right below there. That's how I would play that one. I wouldn't. There was no way I'd be buying that stock right now. If anyone has this position, again, this is a great time to sell at least half the position and put your stop close to the top on that one. Okay, now Mariana has made a comment that I think is really important that I highlight this one. Mariana says, do you put mental or actual stops in? Now, a mental stop is really funny. A mental stop, for those of you that don't know, is when you tell yourself, all right, when the stock closes below that support level, that's when I'll get out. Well, unfortunately, what happens with mental stops is they never fire when you really want them to fire. And here's what happens. Let's say you buy the stock at 16. You're long it on the high. It's now trading 14. It's now trading 14.53, and you have a stop down here at 14.30. It's a mental stop. So you say, okay, well, I just escaped that one. Even though you're losing money, I just escaped that. I'm still in it. And then what happens is it drops below your mental stop area. What are you starting to say to yourself? Well, you know what? I'm in this already. I already have my loss. Maybe I'll buy more. I'll buy more here. I'll cost average down, and then I'll wait for it to go up, and then I'll get out. See, the mental stops, Mariana, they get you in real big trouble. If you want to know where to put your stops, I would go to the Market Guys website and click on videos and learn the 1% rule. Learn it so well that you will teach it to people. Learn it, memorize that video, and that will help you with putting in your stops because you'll use the 1% rule to calculate that. I'm looking at the clock. We have about 4 minutes. I have to end this one a little bit early. I have a call I have to be on at 9 o'clock, but we'll do my best. Okay, Dave, CLV. Let's go with that one. CLV. Dave bought it at 20.50. He bought 400 shares at 20.50. Okay, now you have to watch this one, Dave. You're making money on this one. You have a resistance area right here. You're very close to resistance. Notice there's one place where it just violated, became right back down. This is more or less your average resistance area right here around 22. You're already making money on this one. All right, you're almost, what, 8%, 9%? You're up good percentage here, and you have a very interesting thing happen on today's candle. You had it went up, but towards the end of the day, it started to come back down. You see this little shadow here? And there's it's hard to see, but there's a very small gap right here. Very small gap. It's the gap from this high to today's low, right there. There's your gap. There's a good chance the stock is going to come back down and fill that, which is now going to cut into your profits. Again, this is a great place to sell half of your position. Personally, I would sell all the position. I would sell all of it because you have this move away from the moving average that's quite dramatic. Again, looking at the history of the stock, it does not like to stay that far away from the moving average. Look at this here back in August and back here in May were the two furthest points away from the moving average, with I think the most recent price being a very close second or third to that rubber band being stretched. So I would say take your profits and then do this. Watch. Take your profits. Okay, Dave, follow me here. Take your profits. Oh, let me get my price line there. And then when it gets back to this level, buy back in, right where your entry point was in the first place. See, there's a good chance if you look, there's a lot of times this stock bounces off the moving average after it pulls back to it. So what you do is you put a price alert, sell your shares, put a price alert back there at 21.40 again, and then watch and wait to see if it bounces. If it bounces, get back in. Then you could put your stop down here underneath this support level, and you could use the 1% rule to help you there. Okay, I'm going to hurry up and take one more. Let's see. Apple. All right, we got to talk about Apple. Here we go. Apple. AAPL. Apple broke out of a recent high. We talked about that earlier with Baidu as well. Apple broke out of a recent high, and it gapped up. Now, Look at this. Look how far away it is from the moving average. You know, it's really amazing because look back here. This is when they came out with the new iPhone and everyone hated it, right? They hated it. And then it came back in, bounced perfectly off of support, and it rallied back again. Apple is very, very technical. It does not like to stay this far above the moving average again, especially 1, 2, 3, 4, 5, 6, 7. There's 7 days in a row of green candles, and we are long overdue for a red candle. I would not be bullish on Apple right now because of that above the moving average. But the other reason, it's hard to see, there's a gap down here on Apple, very small one, that still needs to be filled around 460. That is a huge price range between this high and this gap level. So you have to be really careful with that one. You have to absolutely use your risk management skills and be able to sleep at night. Folks, I'm going to have to hop. I want to thank you so much for joining us. This is being recorded, so you can check that on the website, the member page especially. Be sure to subscribe to the Market Guys Facebook page. I am putting comments there, and I am posting the alerts for those of you who are subscribers, I am posting the alerts that your trade alerts have been sent to your mailbox. So pay close attention to that, and we'll talk to you next time. Have a good evening. Bye-bye.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.